Hello everyone, this is Crypto BitLaw back with another blockchain law policy and regulation update. Today is Thursday, February 3rd, 2022, and here are the major movers and shakers in the industry today. So we can see a plaintiff in the staking tokens lawsuit with Tezos, where they were staking Tezos and they were suing the IRS for some sort of clarity with regards to how their staking rewards should be taxed. They turned down the IRS's settlement offer and they're moving to push for clearer policy on staking taxation. The UK government updates its crypto tax rules for DeFi and staking. A hacker steals $320 million from Solana and Ethereum bridge known as Wormhole, and the Australian billionaire brings a criminal case against Facebook over fake crypto ads. So, as always, if you like this content, please hit the like button, subscribe to our channel. You can follow us on Twitter. Our handle is @CryptoBitLaw on Twitter. And with that said, let's dive right on in. All right, first up on the docket, we could see this is a update to an update that we posted last night, which was a continuation of this story that we've been running on the Tezos staking lawsuit, where a proof-of-stake validator is suing the IRS to get some sort of clarity on how their staking rewards should be taxed. So yesterday, Blockworks broke that the couple had attained a settlement and that the IRS was going to treat staking rewards as not taxable until you actually transferred or sold those tokens. But it turns out today we have a little more clarity on this situation. As we can see, this update only broke about 33 minutes ago. So let's dive on in and see what's happening. Cointelegraph reports that proof-of-stake validator turns down IRS tax refund offer, pushes for clear policy on staking taxation. The Tezos validator, who took the IRS to court, argues that staking rewards should be treated as created property rather than income. A United States couple suing the federal tax agency over Tezos staking rewards taxation chose to forego a tactical victory and engage in a court battle that could eventually result in policy change. Joshua and Jessica Jarrett, who run a node on the Tezos network, thus, quote, baking new blocks in the ecosystem's lingo, have sued the Internal Revenue Service over taxes paid on the Tezos tokens created in 2019. The Jarretts filed a refund claim on upwards of $3,000 paid on the tokens, which the IRS ignored. The fundamental point of contention underlying the lawsuit is the classification of staking rewards as either taxable income or created property, which is not taxed until it's sold. The Tezos bakers argue that earning coins by staking is akin to baking a cake or writing a book, and thus these coins should not be treated as taxable income. On February 3rd, Joshua Jarrett released a statement that the U.S. government has offered a refund of the taxes in question as part of the settlement. Jarrett said that, quote, at first glance this seemed like great news, but he later realized that without a court ruling there would be nothing to prevent the tax service from taxing his staking rewards again. Jarrett said, quote, a year and a half into this process, the government didn't want to defend the position that the tokens I created through staking were taxable income. I need a better answer, so I refused the government's offer to pay me a refund. Jarrett's statement further indicates that his ultimate goal is to get the IRS to clarify its position on staking and block rewards for both proof-of-stake and proof-of-work systems. He maintained that, while no guidance exists on the matter, the tax authority's concession in his case could be interpreted as support for the position that staking rewards are not taxable income. Reed Yeager, former staffer at an industry advocacy group known as the Proof-of-Stake Alliance, stated, the decision by the IRS and the DOJ to offer a refund without taking the steps to correct poor policy places American businesses and American innovation at risk. A subsequent court ruling on whether staking rewards are taxable income or not will likely become a critical juncture for the POS, proof-of-stake industry. And so I think that this is ultimate clarification of what's transpired in this case. Clearly, I mean, the IRS offered a settlement to these plaintiffs, and they looked at it and they realized, like, hey, even though we're going to get what we want, what we asked for in the complaint, which is a refund, what they really want, the buried lead, is clarity and some sort of jurisprudence, precedential law for how these rewards, these staking rewards, should be treated. They want the court to issue some sort of precedent on how to handle this situation. And as we could turn here and see the docket, that's also going to be linked in the description below, we could see that as of, let's reload it here, we could see that the most recent update was the 21st of January, and it was a notice by the plaintiffs of a withdrawal of their counsel. So their lawyer withdrew. So there's no update here in this docket with any sort of settlement agreement or dismissal of this case. And as we could tell by this report, the Jarretts, the plaintiffs, were offered a settlement and they ultimately turned it down in favor of obtaining some sort of jurisprudential precedent with how to handle this type of situation in the future. Now, diving back into the docket, we could see that a bench trial has been set for March 7th of 2023. So that's over a year from now. And because it's a bench trial, this is going to be held by the judge. So ultimately, the judge is going to be the one deciding this. So I think that this is an interesting update. We'll definitely keep tabs on this docket and keep you posted as things develop. Next up, we could see that the UK government updates crypto tax rules on DeFi and staking. Decrypt reports that Her Majesty's Revenue and Customs Office has updated the tax rules that govern decentralized finance and staking. They say, Her Majesty's Revenue and Customs, HMRC, the UK's Tax Payments and Customs Authority, is analogous to the United States' IRS, has updated the rules that govern decentralized finance and crypto staking. Quote, the lending/staking of tokens through decentralized finance, DeFi, is constantly evolving area. So it's not possible to set out all the circumstances in which a lender or liquidity provider earns a return for their activities and the nature of that return, the HMRC said. As a result, the HMRC has set out a series of, quote, guiding principles that act as general guidance on determining the nature of related returns to DeFi or staking, whether or not they should be classified as income or capital gains. That is, was the return earned by the lender or liquidity provider by providing a service to the borrower or DeFi lending platform, or was the return realized from the capital growth of an asset owned by the lender/liquidity provider? So, the HMRC has published 4 distinct points designed to assist individuals in determining the nature of their return. First, whether the return received by the lender or liquidity provider is known, quote, at the time the agreement is made. If it is known, this would indicate a revenue receipt, but if it's unknown, it would indicate a capital receipt. Second, if the return is realized through the disposal of a capital asset, it indicates a capital receipt. In contrast, should the return be paid by the borrower or DeFi lending platform to the lender or liquidity provider, the return should be classified as a revenue receipt. Third, one-off payments are, quote, more likely to have the nature of capital, while recurring payments are more likely to have the nature of income. Lastly, Her Majesty's Revenue Council cites whether the period of lending is fixed or indefinite, short-term or long-term, as another variable that determines the nature of the return. So in terms of reaction to this HMRC guidance, Ian Taylor, an executive director at Crypto UK, a special interest group, has criticized HMRC's stance. He stated, HMRC treats crypto assets as property for tax purposes. However, this is inconsistent with the approach currently being adopted by the government and other regulatory bodies in the UK, including the Treasury and the FCA, who regard crypto assets as financial instruments and regulate them as in line with other financial services and products. He added, this inconsistent approach by the HMRC creates friction for crypto investors, adds undue reporting requirements for consumers, and creates tax compliance confusion. And I think that that is the ultimate theme of this narrative, tax compliance confusion. You know, here I am, I'm an attorney, and still, I couldn't understand damn near half of what was going on here. You know, I'm sure if I, really sat down and broke this all down and parsed out all the language and defined all these different terms, then we could actually get to the point where we have some sort of a guiding framework or a set of principles that could lead us through this horrid maze of regulations and guidance. But the way that they're setting it up now, I agree with this Ian Taylor guy. They're treating it one way, as property for tax purposes, but then when we're analyzing crypto under the guise of DeFi and staking, we're going to treat it completely differently, and we're going to send the taxpayer through this long convoluted maze of issues and guidelines in order to have them hopefully come to some sort of pot of gold or whatever at the end, where they figure out, okay, hey, this is what I owe, this is how I'm taxed. But ultimately, like what this guy said, the approach is inconsistent, and it just creates more headaches. So, I applaud them for trying to tackle this issue, the UK government, but I really think they're going to have to dive deeper, get a better understanding of these issues as a whole, and then create a even simpler, clearer set of rules for crypto stakers and DeFi participants to engage in when trying to file their tax. Here we can see that a hacker steals $320 million from Solana and Ethereum bridge known as Wormhole. Wormhole helps people move digital assets between Solana, Ethereum, and other blockchains, so it acts as a bridge between these different layer 1s. Wormhole, a protocol that allows users to move their tokens and NFTs between Solana and Ethereum, has confirmed that it suffered an exploit of 120,000 wrapped Ethereum worth over $320 million, higher than the $250 million originally suspected. Quote, ETH will be added over the next hours to ensure that wrapped ETH is backed 1-to-1. it posted on Twitter, adding, "We are working to get the network back up quickly." A message on the Ethereum blockchain, purportedly from Wormhole, states that, quote, "We noticed that you were able to exploit the Solana VAA verification and mint tokens. We would like to offer you a white hat agreement and present you with a bug bounty of $10 million for exploit details and returning the wrapped ETH you have minted." VAA stands for Validator Action Approval and refers to the process by which transactions get approved. The message means that Wormhole assumes with a wink and a nod that the hacker acted in good faith. In return, it will give them $10 million for pointing out a vulnerability, but it wants its $250 million back. So I guess they're trying to do a grovel or a mea culpa and say, "Hey, hacker, yeah, you got us. Here's $10 million, in good faith that you can have, and we won't take this any further. But just give us all the $250 million that you minted yourself and made off with. Give us that back. We want that back." I don't know if that's going to happen, but it happened in the Polychain hack, so who's to say? Yeah, very interesting. I think that this is just another furtherance in this continuation of these. I wouldn't say that this is totally DeFi, but these interoperability platforms, bridges getting hacked, and this is the problem with these things. It's like you have counterparty risk when you deposit your funds into a bridge. Those funds get locked, and then it releases this wrapped asset on the other side that you can operate with on another chain. But when you're depositing your funds, you expose yourself to that counterparty risk. Someone here that ultimately upkeeps this project, they are going to have admin keys, and then you're going to have to rely on them to make sure that the code of their bridge or their contract was properly vetted and audited such that vulnerabilities like this wouldn't otherwise happen. And at this point in the space, there is a continuation of these types of exploits playing out almost weekly at this point. It's only the most tried and true smart contracts or dApps, things like Uniswap V2, that have been forked and poked and prodded to high heaven that really haven't revealed any sort of major exploits in recent memory. So it's just another warning. It's just another warning to be careful where you put your funds and really vet these projects and do your own research before you go putting big money into some of these things. And finally, we could see that Blockworks report that an Australian billionaire brings a criminal case against Facebook over fake crypto ads. Forrest, the billionaire, alleges that Facebook breached Australia's money laundering laws by doing little to stop the ads and that it failed to create controls regarding the ads. They say Andrew Forrest is bringing the criminal proceedings against Facebook for using his image in crypto scam ads on the social media platform. The billionaire said he was doing it for the people to shield them from future crypto scams by criminal syndicates. They say Australian billionaire Andrew Twiggy Forrest has brought criminal proceedings against Facebook, alleging the company failed to prevent false cryptocurrency advertisements using his image on its platform. The minerals mining magnate alleges Facebook, now Meta Incorporated, was criminally reckless for failing to take down scam posts, which have been ongoing since March of 2019, according to a report by ABC News on Wednesday. Proceedings have been lodged in the Western Australia Magistrates Court. Forrest also alleges that Facebook breached Australia's money laundering laws by doing little to stop the ads and that it, quote, failed to create controls or a corporate culture to prevent its systems from being used to commit crime. He stated that, "I'm concerned about innocent Australians being scammed through clickbait advertising on social media." He further stated that, "I'm committed to ensuring that social media operators don't allow their sites to be used by criminal syndicates." Charges have been made under Part 10 of the country's Commonwealth Criminal Code with the blessing of the Attorney General per the report. Now, this is interesting because I know that they have a different legal framework in Australia than they do in the United States. I know that in the United States, in order to have criminal charges brought, it's brought either by a city attorney, a district attorney, or a U.S. attorney. Someone that is acting on behalf of the state, they have the authority to bring criminal charges against an individual. I was a prosecutor, so I acted within that framework, and that's just kind of how that operates. Your only remedy if you've got a beef with someone and you're not operating on behalf of the state is civil recourse in a civil suit, which does not have the same consequences that you would otherwise have in a criminal court, whether that be imprisonment at hard labor or death. or some sort of other punishment. Usually it's imprisonment, or, if you're really, really, really bad, you can get the death penalty, at least here in my jurisdiction. But it appears that in Australia, you can, even though you're a individual or an ordinary citizen, with the blessing of the Attorney General, you can institute these sorts of criminal charges and then prosecute them like that. So I don't know if any Australian lawyers or barristers or solicitors, I don't know what they call them there, want to post in the comments below and provide any sort of clarity. I just think that this was an interesting distinction, just pointing that out. But continuing on, they say, Forrest stated that I want social media companies to use much more of their vast resources and billions of dollars in annual revenue to protect vulnerable people. The people who are targeted and fall victim to these horrible scams with their hard-earned savings, said Forrest. A hearing date has been set and will be held in the magistrate's court on March 28th. So, I mean, this is an interesting development. I think that, Facebook is going to lob their just wealth of cash and capital into lawyers and attorneys in order to fight this thing and probably squish it like a cockroach. But I think it's good that someone's actually standing up to these companies that act, pretty much with unchecked power as monopolies, and they're actually getting challenged in these different jurisdictions. I know that in the United States, they have what I think is called Section 230 protection, where people that post on their platforms, they're not held, these companies aren't held responsible for what people are posting on their platforms, so they kind of shield themselves, the companies do, under that whole Section 230 protection. And there's been a lot of rumblings in the United States to perhaps revise those statutory protections and generate a new sort of framework that would remove those protections from these companies and could potentially expose them to civil suits and act as a sort of natural check on their power. But with all that said, I thought that this was an interesting host of different developments. I hope you guys enjoyed this content. As always, please hit the like button. Also, please subscribe to our channel if you enjoyed it. You can also follow us on Twitter. Our handle's at CryptoBitLaw. And thanks again for watching, and we will see you guys in the next